Good morning. Capitalization rates explained and how to use them. When it comes to analyzing commercial real estate or CRE deals, capitalization rates, commonly known as cap rates, remain one of the most important metrics investors and business owners should understand. Whether you're buying, selling, or refinancing, knowing how to use cap rates can help you make smarter investment decisions. So, what is a capitalization rate or a cap rate? Well, the cap rate measures the expected return on a commercial property based on its net operating income compared to its purchase price. So, really, the formula for that is cap rate equals net operating income divided by, or purchase price divided by net operating income. Is kind of how you get to that. And let me put that in real world numbers because that's the easier way to understand it. So, for retail properties generating 250,000 in NOI, and it's priced at 3.125 million, the cap rate's 8%. So why do cap rates matter? Well, cap rates allow investors to compare properties. A lower cap rate typically indicates a lower risk investment, such as a stabilized Class A office building. It's a gauge of market trends. Cap rates move with interest rates, financing costs, and local demand. It's also a measure of risk versus reward. So a higher cap rate usually means higher potential for returns, but also indicates a higher risk. What are some factors that influence cap rates? So several key elements can drive cap rates higher or lower, including location and market demand. Prime areas like Katy and Fulshire often have lower cap rates due to strong tenant demand. Can vary with the property type as well. So multifamily, retail, office, industrial all have different risk profiles. And tenant quality is a big one. A national credit tenant reduces risk, lowering the cap rate. Lease terms, longer leases provide income and stability and track lower cap rates. And also economic conditions. So rising interest rates and uncertainty tend to push cap rates a little higher. So how do we use cap rates as an investor? Well, cap rates are not the only metric, but provide a powerful benchmark when used correctly. First, in acquisitions, compare cap rates across multiple markets to find opportunities. Valuations, brokers, and appraisers use cap rate to estimate property value. In refinancing, lenders analyze cap rates to assess risk. Exit strategy, investors can plan disposition timing based on projected cap rate trends. So if you think rates are going to get better, it might make more sense to do a deal. Some final thoughts. Cap rates may remain a cornerstone of CRE investing, but they should never be viewed in isolation. Smart investors pair cap rate analysis with cash flow, financing terms, and long-term market outlooks. So if you're evaluating a property purchase, a 1031 exchange, or a refinance in Katy, Fulshire, or Houston, understanding cap rates is essential to structure a deal that works in your favor. You ready to discuss opportunities? Let's connect and find the right investment strategy for you. Thanks for your time and have a good day.